Hello and welcome to this episode of Perspectives. My name is Chris Stegemann, and today I am joined by portfolio managers Bill Campbell and Valerie Ho. Bill and Val, thank you for joining us today.
Thank you for having us.
Great to be here.
So by way of background, Bill and Val are portfolio managers on the DoubleLine global bond and emerging market local currency strategies here. So today we're going to focus on the international landscape. And Bill, I'll start with you. On the international front, it seems that a bear would have their pick of the litter in terms of risks to point to. It's the heaviest election calendar year on record. There's global growth concerns, and then of course, geopolitical flare-ups and even wars. So your thoughts on the sheer volume facing the international landscape today?
Well, you've laid out all the risks very nicely, and I think the risks you've laid out, the market's aware of. I think what we need to do is start analyzing those risks. We've, in previous videos and perspectives with you, talked about the geopolitical risks, which I think at this point, are going to be an ongoing concern, but remain contained. This year, I think the new focus is the election calendar. As you said, over 60 countries are going to the polls, so it's meaningful. When we think about elections, we need to think about what is the concern that market participants have when countries are going into the elections, and they really fall out around three main factors, all revolving policy. First is fiscal policy, second is domestic policy, third is external policy. When we look out across the globe, the majority of countries are facing fairly benign outlooks to each of those three pillars. And I would also say that there are mitigating factors that also come into play when we evaluate elections. And those mitigating factors would be one, growth. Going into an election, incumbents and incumbent parties want to get reelected, and you tend to have pro-growth policies, which will support domestic growth going forward. So the sheer number of countries going into an election, are going to be should have growth supportive policies this year. Second, once elected, there's a need to govern. So a lot of the aggressive campaign rhetoric around those different policy pillars is scaled back as coalitions need to be formed in order to pass legislation and govern. The two biggest election risks this year, as far as our team's analysis, really revolve around one, Taiwan, and that is now behind us. The outcome there was about as benign as we could have hoped for. Although the DPP's William Lai did become president and he's pushed back against reunification with China, the DPP lost the majority in the legislature, which makes status quo the most likely. The second election that's the biggest risk is the United States, where all three policy pillars, fiscal, internal, domestic policy, and external policy, those uncertainties are going to increase into November. But leading up to that, a benign growth outlook globally, where fiscal policy is going to be net supportive to, especially in the major economies, should put investors at ease in allocating capital outside of just U.S. domestic fixed income portfolios.
So what I'm hearing is most of these elections are more smoke than fire from an investment risk standpoint. So Valerie, I'll turn it to you. Let's take a step back. How can elections impact financial markets?
Yeah, so going into a very heavy election period, it's very important to think what are going to be the market impacts. In general, when we start thinking about elections 3 to 6 months out, you begin to see, as Bill alluded to, a lot of fiscal impulses, pre-election spending, and that can weaken some of the near-term fundamentals, economic fundamentals of the country. So particularly if that spending is allocated towards social handouts, non-productive infrastructure or investment, that typically could be negative for the economic outlook in the near term. Also on the reform agenda, typically as you're moving into an election, politicians, Congress, presidents, they don't like to support some of the more market-friendly reform agendas that may not be as popular with their voters. So there could be some disappointment as you move towards the election and the reform agenda begins to slow. The biggest market impact, which we have seen, has been when you have a candidate that threatens to shake up the status quo. We call this the regime-changing election. This is when a candidate can come in and really has these ideas to change the economic structure of an economy. And we saw that most highlighted in Argentina last year. They had elections. Javier Milei from the far-right Libertarian Party was elected. He unseated the ruling party from the Peronist class, and they had been implementing for a number of years unorthodox policies which have stressed the Argentine economy. And Javier Milei is coming in, and he's really trying to stabilize the economy. And as a result, we've seen a big rally in a lot of the Argentine assets.
So sticking with Latin America and transitioning to portfolios and how you're implementing ideas. Within LATAM, which of course is your coverage, what are you keeping your eye on for 2024 in terms of elections?
Yeah, LATAM has a pretty heavy election calendar. There's two that I think are pretty interesting. One is in Venezuela and the other is in Mexico. So in Venezuela, we're looking at the sort of the geopolitical implications of this election. So the current president, Nicolas Maduro, has made an agreement with the opposition. It's called the Barbados Agreement for free and fair elections. Now, elections haven't been scheduled yet, but they should happen sometime this year, probably in December. And the big question is, what is going to be the U.S.'s reaction to those elections, and whether they're considered free and fair. So after the Barbados Agreement was signed, the U.S. had lifted a number of economic sanctions on Venezuela, and it remains to be seen if those sanctions will remain lifted, or if things like the TSE ruling that Maria Machado, the leading opposition candidate, can't run, if that's going to put sanctions back on the economy. The other election in Mexico should be interesting to watch. We think that we're going to see a continuation of the leadership of the Morena party. The current Morena candidate, Claudia Sheinbaum, she's leading with double digits in the polls against the opposition candidate. So she's likely to win the next presidential election. Key, though, is going to be the Congress. I think the base case for the market is that the Morena party and its allies will take a simple majority in the lower house and Senate. The big risk is if they do better than expected, they get a qualified majority, meaning 2/3 of the House, 2/3 of the Senate. That allows for constitutional reforms, which could potentially lead to passing reforms that could weaken some of the institutional safeguards of the country.
So positioning wise, I know across most of our portfolios, we're overweight Mexico right now for 2024. Is that correct?
That's right. We like Mexico. I think there's a very compelling story there. There's high real rates. It's going through a clear disinflation cycle. So the fundamentals also look really good there. We like the nearshoring story in Mexico. We like the strong remittances. It's generally buffered from some of the geopolitical risks that Bill has gone through, and a pretty benign election cycle for domestically.
Okay, that makes sense. So Bill, I'll end it with you. Val touched on attractive opportunities within Latin America, particularly Mexico. What else on the international landscape outside of Latin America are you finding attractive right now?
Sure. Maybe I could take one step back and just reiterate that when we look at the global backdrop going into the U.S. election, it remains net supportive for emerging markets in general, whether it's dollar-based emerging market local rates, or emerging market FX. What we're seeing on the growth side, as I said earlier, is strong fiscal spending is supporting growth. Especially, we're seeing increased fiscal out of China. We're seeing fiscal in the U.S. going into the election, in Europe, as well as individual countries. Adding to the fiscal policy equation. Also, on the monetary policy side, central banks have pivoted across the globe. We have now moved from a hawkish central bank policy to dovish central bank policy. In some cases, central banks are actually cutting rates. In other cases, we're discussing when the cutting cycle will start. And this is all anchored by a disinflation process that continues to be well underway. I highlight those as positive external backdrops just to put investors at ease that yes, there are risks out in the global economy, especially around geopolitics, but they are buffered by what we view as a fairly healthy external backdrop. What we're generally looking for when we're looking at country-specific trades, we're looking for countries that have well-supported growth models with high real yields where you're being compensated for the risk at this point in the cycle, and institutional strength that's going to continue to support rule of law, fiscal policy, and basic domestic functioning. We like India as a strong carry trade. We think that hits all of those points. They just released their budget outlook today, beating expectations for the market. You have disinflation under control and one of the strongest nominal and real growth rates across the globe. We also like Indonesia. We expect policy continuity out of the election there. We also think it hits the main pillars of supported growth, disinflation process, and strong institutions. Outside of Asia, we like the Poland story. Poland, Donald Tusk came in. He's unleashing EU funds, which should be net growth supportive. And similar to what Val said regarding Mexico, the nearshoring that's happening in Poland will be net growth supportive to that country as well. So central banks likely to remain relatively hawkish, supporting real yields. Disinflation will continue to take hold. So I think the story remains positive there. And then maybe to jump back into Latin America, the other country that we really do like right now is Brazil, where Lula has surprised to the upside as far as maintaining fiscal control, but has had a pro-growth agenda. And we think it remains a very interesting place to be taking risk at the moment.
Okay, well, thank you both. It sounds like on the international landscape, as we started off, there are a lot of headline risks, but there's still very attractive opportunities and reasons to be optimistic for emerging market fixed income in 2024. So again, thank you for joining us today. If you have any questions regarding the DoubleLine emerging market fixed income strategies, feel free to email info@doubleline.com. Have a great day.